And I think our job in wealth management is to remind our clients that they should focus on the longer term and try to weather the storm and look ahead. We are managing retirement savings. We're investors. We're not traders. And investing is about time and the value of compounding returns. It's not about timing. So a big part of our job is to try to comfort our clients about the longer term outlook for markets, reminding them of what their investment objectives are, rather than try to react to either peer pressure or to the news flow. I think if you try to trade on the news flow, you're bound to lose money.
Okay. But there has been this rather awkward question of whether European wealth centres are going to get a boost from the unrest in the Middle East. I mean, already here in the UK, we've seen some politicians talk up the benefits of being in Britain rather than maybe in one of the Gulf states. Do you think that will happen, or is happening now?
I think it is happening. I think there are three dimensions to look at. The first one is obviously diversifying your investment, and this is what clients have done, and we've advised clients to do for many years. There are two new things that have been happening. The first one is that people have started to realize that wealth, especially the high net worth wealth segment, is very mobile, and therefore we've seen people moving away from certain regions into others, and obviously the UAE has been a primary beneficiary of that wealth migration, and that, given the uncertainty of the geopolitical situation in the region, might come back into question, and we might see some reversal of some of those movements. The third one is, as much as you diversify your investments, high net worth clients now want to diversify their booking centers as well. They want to diversify where they custody their assets, and therefore our job is to be able to provide optionality to clients so that they don't put their eggs in the same basket for both investing and for safeguarding their assets. And in that respect, yes, we might see some flows coming back to Europe and obviously to Switzerland. It wouldn't surprise you for me to say that.
Yeah, I was going to ask, is it going to be Switzerland? Is it Milan? Is it Frankfurt? Is it London?
Yeah, I think it depends what you're looking for. The business of wealth management is about establishing trust with your clients, and trust is a function of a few things. It's a function of the expertise you have. It's a function of the understanding you have of your client needs. And in Switzerland, we have been doing wealth management for decades. We know about family governance. We know about succession. We know about international investing. We have a pool of talent which is set up to be able to give that advice and deploy the investments internationally. And it's about reliability. So you need a host country where you have a stable government, a strong currency, a strong regulatory framework, and Switzerland offers that. It's not the only place that offers that, but for sure it has its cards to play.
But is the stronger franc going to be an issue for Switzerland's industry in this case?
Listen, the Swiss franc has been appreciating, every year for many years, and Switzerland continues to grow. Employments. We continue to have full employments. We continue to export because we focus on high value added industries and services. And if you're talking about the financial industry, from a client perspective, it doesn't matter, because if you think in euro, you'll be based in euro. If you think in dollar, you'll be investing in dollar.
Okay, so that's maybe a little bit of a sales pitch for Switzerland, the advantages of being based there. I want to talk about other things, though, that markets are concerned about. Private credit, retail investors pulling out billions. There are individual stories that have raised their global concern. How worried are you about private markets?
I think the danger in private markets is to try to picture liquidity when there is no liquidity. Private markets are illiquid markets. So any wrappers that try to provide a liquidity that doesn't inherently exist is dangerous. And when we talk about democratizing private assets for retail investors, which is what you were touching upon, if democratization is about providing access, we're fine with it. If democratization is about trying to provide the illusion of liquidity, this is when it becomes dangerous. Because if you need that liquidity for your own personal reasons, you might get it. But if there is a crisis and everybody's rushing out of the door, you're not going to get it. Private assets
is that what you feel is?
I'm sorry?
Is that what you feel is happening? Do you think this is a crisis with the volumes of investors that are pulling out of what they're pulling out of these funds?
I think that if clients are investing anything else than their reserve assets, the assets that they don't need, into private assets, you're bound to have a problem at some point in time. So I think you need to be very aware of where you're investing, and from an asset management perspective, you need to be extremely transparent about the terms of the wrappers that you're offering.
Okay, I think that's quite interesting on private markets. Then also focus on industry, consolidation in the industry, the sale of Schroders, for example. I mean, there's lots happening in insurance we're talking about today, but that's just today. Thinking about your industry in particular, do you think that there will be more consolidation? This is a key question for Europe.
I think there will be more consolidation, but I have to admit that in our industry, in the wealth management and the asset management industry, I'm very doubtful that consolidation brings value to clients. Sometimes it brings value to shareholders, but rarely to clients. What we have seen invariably when there are big mergers is that the management is taking their eyes off the ball, and in that case the ball has to be clients, because they're too busy integrating operational platforms, tech platforms, establishing retention plans or redundancy packages. And performance erodes, the quality of the service goes down, talent leaves because they don't know whether they're going to have a job tomorrow or not, and clients as well leave. So as far as we're concerned, we don't view that as a necessity in our industry. And as far as we're concerned, we never engage in M&A. It hasn't stopped us from growing faster than the industry. You can acquire talents. You don't need to acquire the legacy that comes with the whole operational platform when you acquire a firm.
One of the other big themes, of course, that has been on markets over the past, several years now at this stage, has been the speed at which AI is being adopted. Of course, that's been driving a lot of the share price of some of these big companies as well. But on a practical point of view, I'm wondering, how much are you using AI in Pictet, and how much are you using it personally?
Yeah, we will use, and we are using AI wherever we see the potential to provide an even finest service to our clients. So we were one of the first Swiss bank to roll out an internal chatbot a couple of years ago. We have now given access to our people to Perplexity, to Claude Codes, to Copilots. We have 80% of our staff which are daily users to one of these tools, and at the same time, not only do we provide the tools, but we also provide training, teaching them how to use the tools. So we are rolling out now, as we speak, a masterclass on AI for us, the 7 managing partners, for the equity partners, for the top management of the firm, and that will trickle down throughout the organization to make sure that everybody can embrace it and be augmented. And I think there are different areas where we see its value. Obviously, in some area, if we can increase productivity and free up time for bankers, relationship managers, portfolio managers to focus on higher value-added tasks than repetitive processes, it's a benefit. We are using it to automate some tasks, and I'll give you concrete examples, or also to try to improve the way we deliver service to our clients, or we make investment decisions. In the area of compliance, knowing your customer processes, contract management, cross-border rules, reporting, responding to requests for proposals. I mean, there are plenty of use cases where AI makes you simply much more efficient.
What about the risks, though? We have been looking at the meetings taking place in the US over the Anthropic model, Mythos, and the cybersecurity risks that poses. US regulators calling in the banks to find out how prepared they are. How concerned are you about the cybersecurity or other risks from this technology?
Of course, I think the biggest assets we have as a financial institution is our reputation, and the biggest risk for our reputation is to be attacked, and denial of service is an absolute it's an absolute killer. It's what keeps us awake at night, and therefore we spend a lot of our investments on making sure that our cyber security is up to standards, and constantly investing to make sure that we can cope with any attacks that we would have. And so far so good.
Okay.
But it's definitely, as much as you invest in AI, you need to invest in cyber.
Right, cybersecurity. Yeah. Okay. We're kind of coming to the end of our thoughts. We talked at a very high level about the industry and how you see it, which I think is really fascinating. Do you think that the war in Iran is a support for active management versus passive management? What do you think it means for the industry?
I think the war in Iran is going to trigger two things. First, I think yes. I think whenever there is a heightened period of volatility, this is when active management can actually play its cards, and therefore, yes, I think active management can deliver value. I think the other thing that may happen following the war in Iran, despite what is happening on the other side of the Atlantic, is that we might be on the cusp of a renewed interest and investment wave in clean energy transition. I think, and not on the back of climate change, on the back of building strategic autonomy. Energy has been weaponized, and therefore the ability of government to achieve energy independence is managing a geopolitical risk. And that, I think, is a very, very exciting opportunity.
Is the goal then to be energy independent? Because Europe is an energy importer, and that is seen as a massive Achilles heel. Is there really a push to become energy independent?
Of course, but they have upped their game since the Russian invasion of Ukraine. Today, if you look at Europe, if you look at solar and wind, it produces more energy than fossil fuel. If you add hydro, it's above 50% of the energy mix. So they are making progress. If you look at what's happening in China, they're definitely on a path to become energy independent. So I think that if there's one lesson to take from the current crisis, is that you cannot just rely on oil being important from abroad, because it puts you at risk.